Hello and a very warm welcome to you on Business Today Television. We continue with our coverage of strong earnings growth in the fourth quarter by corporate India, and today's focus is a company which is in the world of water treatment plants. We are talking about WABAG, where the fourth quarter performance has come up with a fairly strong show. Fourth quarter sales rose 22% to 1,414 crore rupees. Net profit was actually rising faster, 29% higher at 128 crore rupees. This is both a sequential rise year on year as well as on the quarter gone by. The market capitalization of the company is about 9,500 crore rupees. And joining us on the show is the CFO of WABAG, Mr. Skandaprasad Seetharaman. Good morning to you, Mr. Seetharaman, and a very warm welcome to you, sir. Strong show, very good order book. What were the primary drivers of the rise in net profit?
I think we have been demonstrating this over the last 2 to 3 years already, with our medium-term outlook being given out, that we'll grow at a range of 15 to 20% at least, and that's what we have been demonstrating. The strong order book is an important factor that has been constantly rising. If you see the order book position, today we stand at over 17,000 crores, which is again more than 25% from what we closed last year. And execution has been picking up. The larger projects have moved into advanced execution. Newer projects are adding to it. So all these have been contributing to the top line. But most importantly, as you rightly mentioned at the start, we've been growing profitably, and that's our mantra, profitable growth. Our bottom line growing at a rate faster than top line, which demonstrates operational efficiency, how we manage our cash.
Both the order book plus sales. How much of this order book is domestic?
Broadly about 50% is what we generally have on an average. It can vary between periods, but broadly our outlook is 50% with a bias towards the international, because we are seeing larger orders and larger pipelines in the international vis-a-vis the domestic order book.
Okay. When you look at the geographical spread of about 9,000 crore rupees of order book, which are the geographies that stand out in particular? The reason why I ask is that a large part of the water desalination business is focused on the Middle East, and there are problems galore there.
I think it is a fact that there is a geopolitical issue. But what's important to see is what we are as an organization, right? We are not a single country or single region dependent organization. We have a very diversified order book. We are present in over 25 countries. We have Middle East, the African region, Southeast Asia, SAARC countries, India, CIS. So we are spread everywhere. So this allows us to have a consistent and profitable growth journey, because obviously there will be different factors in each region, but no single region should weigh on the overall growth of the group. We have been very clear on diversification. We have done it consistently, and it has also helped. And you mentioned about desalination. Point to understand, we are not just a desalination company. There is reuse, there is municipal water and wastewater. There is this big industrial bit where we talk about ZLDs, ultra pure water, effluent treatment plants. All this entire basket of water treatment is there. So business is moving well. Even in the Middle East, we have had hardly any disruption on our projects. So, and the most important thing to see about this geopolitical tension, Shailendra, is that it is only going to build more importance towards water security, right? These regions are going to build redundancies and reserves. And that's going to be a tailwind for the business rather than any headwind.
Right. See, I understand the necessity, the importance of water treatment across the board. There have been stories galore that the next war will be on water. rather than any other asset. And one understands the importance that you are referring to. It's just that it's a business to business segment that you are in that has its advantages as well as problems. So those were the ones that I thought I should bring into consideration. So 17,000 crore rupee order book. What I notice, Mr. Seetharaman, is the absolute strength that you have on your operating margin. It's vacillated between 11 and 12, 13%, whether it's quarterly or year on year. Are you hopeful of bettering 11, 12, 13%, or is this something that we should live with?
I think in the last 2 years, we have already come into the 13 to 15% EBITDA band. You see, last year we closed at just about 13%. This year we are already in the mid between 13 and 14. And as the volumes increase and our spectrum of orders also increase, size, complexity, and geographical spread, this is bound to go up. And that's why we have given this range of 13 to 15%. We are very confident that we will stay in this range with the quality of orders that we have, the kind of payment securities we have, the multilateral orders that we have, and the kind of industrial orders that we are pursuing in all the regions that we are present in.
Okay. Traditionally, March has been a strong quarter for you.
That's true. It's usually the period when governments have to complete their budgets. It's the time when significant deliveries happen, especially as you mentioned previously. That's the biggest advantage of a B2B and a B2G business, is that you have a H2 heaviness because businesses want to move. The deliveries happen faster, the construction happens faster, monsoon is also fairly settled. So it's a good time in terms of construction and infrastructure. So we'll always have H2 heavier than H1.
Fair point. Mr. Seetharaman, let's look at capacity which is utilized for the quarter gone by. You will also have an annual number for the financial year that's just you've reported upon. How has capacity utilization worked at this point of time?
See, when we talk about capacity utilization, we basically talk about how productive we are, and that reflects in how we are growing. So the pure reason how we are growing profitably is because we have better margins right at the project level. That's the utilization of resources. Number two, we have control over the fixed cost. That is the utilization of our manpower. And third, you would see today our numbers are reporting a net interest income rather than a net interest cost. So we are managing our cash well, that our treasury has become a profit center rather than merely spending money for interest. So whether it is money, material, or our WABAG, as we call the people, the engineers, all productivities are firing, and that is how the profitable growth, whether it is at EBITDA or PAT, is purely reflecting. And as we move forward, you know, this business is a very modular business. We don't have to increase fixed costs at the rate at which we increase our top line, and that gives us the ability to keep improving our margins. And that is why we said the band of 13 to 15 is something that we look at with an objective to keep improving this margin as we move forward.
Mr. Skandaprasad, is there some business that you refuse because of potentially lower margins?
We have a very comfortable order book. We've been having a comfortable order book. We've never been in the business of going for orders with lower margins. We have a threshold. More than the price, I think as an organization, we are a value-based organization. We present to the customer what value and what solution we bring to the table. So our margins, you can see in the last 4-5 years at least, has been about 20 to 23%, the direct margins. And our EBITDAs have been in the range of 13 to 15. So we obviously don't like a price war. We are in the high technology segment where we compete with large competitors for advanced technology and complex projects. So in a way, our segment is value pricing rather than purely L1 pricing.
Okay, fair point. How about return on capital employed? I see return on equity being fairly constant. ROCE for the moment stands at about, it's a very high 21.3%. Is this something which should continue in the quarters, years ahead?
Our medium-term outlook is to take it beyond 20%. We are there at the moment. If you see ex cash, we are probably much higher than the target already. And we have very light balance sheet. We don't have assets. We're an asset-light organization. We don't like to bulk up our balance sheet. So our investment is only the working capital and how we make the profitability out of it. So it's a good journey that we are on in terms of ROC. ROE also used to be at 15, now it's hovering towards 16. So both the return ratios, whether it is ROC or ROE, are on the right track, improving track, in line with our profitability, cash, and our balance sheet strength.
Is there a fresh capacity coming on stream for FY27?
From what perspective you're saying?
In the sense, maybe you want to set up a new construction plant. I agree the order book is very strong, but are you sort of comfortable making these orders from existing facilities? I just want to find out whether you are putting in a new factory.
See, I think there are two parts to our order book. About 6,000 crores is the O&M, which is like a consistent annuity, asset-light, cash-accretive business. The other part is the EPC, which is about 11,000 crores. And that gives us a good visibility already for the next 2 to 3 years. The pipeline in the countries and regions that we are present in is very robust and strong. We are already preferred bidder in a few large projects, which will add to the order book in the next year. So you will see that the larger projects will advance, the newer projects will start, and we'll have a very good bouquet of projects across the world that we'll be delivering and growing on even for the next year.
Okay. The depreciating rupee is good news for you.
Yes, it is. We are a export organization in a way, and we borrow less. We make more money out of our exports. So the depreciating rupee is good in that sense, and that's very clearly reflecting also in our operating forex gains. So all our operations which are in the international space, converting to INR, you would see that it is giving us better gains. And most importantly, I think we are bringing dollars to the country, which is something I think the government and the Prime Minister has been emphasizing on, and how we can conserve and build on it. So in that way, we are very happy and proud that we are contributing to that.
Because you're a B2B business, the debtor days also matter. I see them stagnating around, 220, 230, 250. You're comfortable with that? That's about, 2/3 a year.
Shailendra, always it's a dil mange more. We'll keep improving. We have seen it improve, but the way we manage working capital is on a net basis, right? If you see the debtor days, you should also see the creditor days. So in a way, at 104 days of working capital for an EPC organization is, I think, it's one of the best in class. Yeah. And we will keep improving this, obviously, with the quality going up. Sequentially, the working capital will also improve, which means the debtor days, the creditor days, all of this will only look one way, becoming more efficient.
Okay. I'll also share with our viewers the stock price chart of WABAG. For the last 5 years, ladies and gentlemen, WABAG has appreciated at a CAGR of almost 38-39% a year. That's a phenomenal growth and value creation for investors. You have, you are net cash positive. 357 is total debt. Cash on the books is about 1,060 crores. You're comfortable with 357?
See, that keeps hovering. In fact, this year our debt is much lower than 357. We're about 220 odd. Our net cash is about 950 crores already. So we are close to that 1,000 crore mark in terms of net cash adjusted for debt. So that way, it's again a Dil Mange More situation. We'll keep improving. You would see even from last year to current year, the net cash is up by more than 30%. So we are also adding cash and also ensuring that the capital allocation is good. That we are reducing our debt. We are paying dividends to the shareholders. Last year we paid 4 rupees a share. This year the board has recommended a 5 rupees a share to the shareholders to approve. And we are also investing in some of the HAM projects as we move forward, which will also be a good appreciation and an asset build-up for the shareholders. So end of the day, any action we take is shareholder value accretive, whether it is building cash on the balance sheet or building assets which will improve the valuation of the shareholder.
Okay. What will you do with so much of cash? You're not in the business of acquiring companies. There would be hardly a water treatment company available overseas.
See, that's never been our priority. The organic business is good enough, and we have a 100-year track record and enough technologies to be on the table with the best of the competition and probably beat them. So the inorganic path has never been our priority. We focus on partnerships mainly, whether it is technology, construction, finance. We try and see that we are building partnerships with people, non-equity partnerships or mild equity partnerships, and that's the way forward. As an EPC organization, it is also good to have some cash on the balance sheet because especially in times like these, when we are on an expansion path, this cash will give us a lot of ability to bargain and also, like you said, refuse some of these projects very strongly when they are not meeting our thresholds. So that way, we are looking at building a strong balance sheet. And one of the points is to have a good cash balance, which can give us the ability to be better on the table.
Okay. Just an aside, what's the average that you earn on this cash deployed?
See, it depends on the country. Double digits used to be the case when it was in Russia, but you could take, anywhere between 5 to 7% at least.
Okay. Wonderful speaking to you, Mr. Seetharaman, and it gives you a wonderful insight into the world of B2B corporate India. Here's wishing you all the best. Looking forward to higher OPMs and better NPMs, rising ROCs and rising ROEs. Have a good day, and here's wishing you all the best.
Thank you, Shailendra, for your insightful questions, and thank you to all your viewers for their continued support to us.
Wonderful. This was Mr. Skandaprasad Seetharaman, CFO at VA Tech WABAG, one of the very well-known water treatment effluent plants in the company. Thank you for watching.